why would I use Utila instead of, let's say, Fireblocks or building in-house solution?
It's a very good question. I will also talk a bit more general, not only Utila blocks, but mostly talk about the market in general and what are the options that fintechs are having today. Okay. So when a fintech is entering the stablecoin space, they need a combination of a few things. Okay. They need, and it doesn't really, and it not really depends on the use case they want to solve. In every use case, they will need more or less the same thing. So whether it's like pay-ins, payouts, treasury managements, in global settlement, they will need wallets. Like they will need the ability to hold different forms of stable coins. And move them around, of course. So initiated some transactions. They will need things around compliance, we are receiving or sending funds. How we make sure it's with AML, travel rule, etc. They need liquidity. Okay. So they need the ability to convert from USD to USDC, from USDT to, to a Brazilian real, right? So they need the ability. You need to swap sometimes because in some case they will get USDC, but they need USDT for the off-ramp side, right? So they do need this liquidity, and they also need licenses in some cases, right? Because when you start working with stablecoins, even if you have a payment license, you are an EMI, you still let's say need a MiCA license because you operate in Europe on stablecoins, right? And in many cases won't have it, right? So now, fintechs have two options. One option is to go and use a provider that have everything already inside, which is, I like to call them black box or stablecoin 1.0, which is more good for when you experiment with stablecoins, but you don't touch them yet. So BVNK, Bridge, Zero Hash, there are many players in this space. The good thing about them is that they give you everything out of the box. You don't need to take care of license, wallets, AML, everything is one place. You can tomorrow come out with a PR, hey, we support stablecoins.
Correct.
What we see, and the second option is building your own stack that you control. Okay, so you are setting up the wallets, you are connecting these wallets to different liquidity providers, you set up your AML rules, with Chainalysis, Elliptic, TRM, etc., and you also have your own licenses. So that's the ways of doing things. We expect to see fintech players eventually going in the second direction. Okay, so when they start, especially not having licenses, actually enforcing them to use the first option, which is having a provider that is more like a black box with everything inside. As they grow, fintechs, payments companies in general, they want to control the stack. That's the way to get bigger. Okay. That's why, and that's the narrative that we are seeing a lot, stablecoin 2.0, which we call it, which is the second evolution, which is moving from black box providers into we owning the stack. We have our licenses. We work directly with liquidity providers. This can solve 90% of the costs today.